Welcome into this week's video. I wanted to do something different for video today. What I ended up doing is I asked AI, ChatGPT, what the top 10 reasons for owning whole life insurance. What are the top 10 benefits? So the very first reason that ChatGPT says an amazing benefit, whole life insurance, lifetime coverage. Whole life insurance does not expire. It's not a term life insurance policy. A term life insurance policy is typically going to be 10, 15, 20, or 30 years of coverage. And a term life insurance policy, you pay a level premium for 20 years. So for $1 million of coverage, you might be paying $100 a month. And it's going to be enforced as long as you pay that $100. There's no cash value accumulation. If you don't die, it doesn't pay a death benefit. And if the 20 years is up, then the policy is gone. Or you have to pay an exorbitant amount of premium to keep the policy going, and it's just not worth it. Most people will just let the policy go. Whole life insurance, permanent life insurance is there forever. It has no expiration date, and at some point you will use the death benefit, right? I don't know when that'll be, but the death benefit will pay out. The next benefit is cash value accumulation. That's probably one of the biggest reasons why people typically, come to Money Insights and come to me to talk through whole life insurance is for the cash value accumulation. As you fund a policy, assuming that it's structured correctly, and that's very important with whole life insurance, is that the structure of the policy is meant to build cash value accumulation. A lot of the reasons people don't love whole life insurance before they get to know it is because they've seen whole life insurance policies that just don't perform well. They don't build very much cash value. And so if the policy is structured correctly, you can get quite a bit of cash value building right off the bat in year one. And so the cash value accumulation is a great tool to utilize. It's equity in the policy that you have access to while you're living. And I think that's a key component is, a lot of people view whole life insurance or just life insurance in general as a death benefit, right? Something for their heirs or their beneficiaries, their children, their grandchildren. And while that is the case, right, at some point, like I said, with whole life insurance, at some point the death benefit's going to pay out and it's going to be an important piece to their estate planning. However, the cash value is available and liquid for you to be able to use for any purpose. There's no restrictions on what you're using that cash value for. So the cash value accumulation is a key benefit. The next one is fixed premiums. And this one I'm going to change a little bit because in this context, it's talking about fixed premiums for the life of the policy. And that's true if the policy is built just to stay alive for as long as you pay the premiums. However, again, going back to the structure of the policy, if you structure the policy correctly, you can actually get that premium to go away. Or in other words, you can overfund the policy on the front end, even in a matter of 3 or 4 years, and you can get enough critical mass in the cash value where the policy can self-sustain itself, meaning it can pull from the cash value, pay the premium, and grow more than what the cash value was the year before, even after any fees are taken out. Next one's forced savings component. Again, I'm gonna change this one. Instead of a forced savings component, most of the time when people are coming and talking to me, it's gonna be more of an emergency reserve fund. So most people have an emergency reserve fund, could be $100,000, $200,000 that you keep just in cash as an emergency reserve. Most people keep that very liquid, right? They want that in a checking savings money market. It's not gonna be invested where it can lose anything. So most people that work with me, they're just going to transfer that 100, 200,000 in the emergency fund, and they're going to transfer it over into their whole life policy. And the reason for that is because over 30 years sitting inside a checking savings money market account, you might average 1% if you're lucky sitting in something like that. I don't think there's many accounts that over 30 years, a high yield savings, I don't think it's going to yield you much more than 2%, maybe even 3%. But let's say it does get you 3%. Sitting in a whole life insurance policy, that's, consistently for the last 100 years, you're going to be able to average at least a 5% return, right? Which is much better than a 3%, especially when you're compounding that over 20, 30, 40 years. Most people will move their emergency funds, maybe not all at once, right? They might transfer 50K at a time or 25K at a time, and they're going to do that for 3, 4, 5 years until they get their full emergency fund over into the whole life insurance policy. Now, not only do you have the emergency fund, you have significant death benefit that's also going to be there, which is another layer of protection. In addition to that, most life insurance policies in most states, it's depending on the state, they have a form of creditor protection, meaning at least a portion. Here in Utah, the full cash value of a life insurance policy is creditor protected, meaning if somebody got into an accident or there's a lawsuit against them, their checking, savings, money market is fair game. People can come in and take that in a lawsuit. Whole life insurance, they cannot do that with. Cash value life insurance, they can't touch it. Again, it's depending on the state, but there's also ways to utilize LLCs to own the life insurance policy to help with that as well, which is also, one of the other benefits that it's ChatGPT saying here, which is estate planning. Life insurance can be a huge asset in estate planning, whether it's estate equalization, meaning providing liquidity for the estate so that, if you have 5 children, all the kids are taken care of. A lot of times this happens in like a business, or if one of the kids wants the home, they want to live in the home. Let's say the total estate's worth let's say $5 million. The home's worth $1 million, and there's 5 kids, right? One kid wants the home. Well, the one child can take the home for $1 million, but that also means that there needs to be $4 million that's paid out to the other 4 children, right? To make sure that it's equally distributed. Whole life insurance in general, paying out tax-free can be a huge asset in equalizing the estate, providing liquidity and cash to make sure that everything is equally distributed. In addition to that, a lot of the clients that I work with are going to be over the estate tax exemption. The estate tax exemption, right now it's $26 million. It's going to sunset to $13 million here in, I believe, 2026 for a married couple. We don't know what it's going to be in 20 years or 30 years or 40 years. However, it's likely that there's going to be some level of estate tax that you've got to pay, especially if you've done well. And so what we can actually do is create an irrevocable life insurance trust, have the policy owned by the ILIP, the irrevocable life insurance trust, that actually takes the life insurance outside of your estate. So when the estate tax is being calculated, the life insurance isn't included. When the death benefit pays out, it pays out to the estate, again, providing tax-free liquidity to the estate to pay for any sort of estate tax that's going on. Most of the time, somebody's estate, it's a $30 million estate. Most of that $30 million is going to be an asset, something like a business, pieces of real estate, right, investments. And so you may not want to liquidate those. Well, if you have tax-free life insurance, death benefit coming in to provide liquidity, you don't have to liquidate any of those. If you want to, you can. In most cases, most children wouldn't want to liquidate those kind of assets. They'd want to keep them. But if there's an estate tax looming over them of, $8 million, it sure would be nice to have tax-free death benefit to pay for that right outside of the estate again. Okay, the 6th benefit, dividend earning potential. Again, you got to work with a mutual insurance company. If you're not working with a mutual insurance company, they're not going to pay dividend. We only work with mutual life insurance companies for that specific reason, because they pay a dividend. And again, if you work with a company that's been around for over 100 years, they're A-rated, they're consistent in paying their dividends. The companies that we work with have been paying dividends for over 100 years straight, some of them even over 150 years straight. You can count on that dividend. It's not guaranteed, right? There's a guaranteed portion of the interest that gets paid every year. Anywhere from 2 to 3.75% is guaranteed, depending on the insurance company. And then there's a dividend that typically gets paid out. Again, it'd be very odd for the dividend not to get paid out. Dividend earning potential, you can pretty much count on that dividend being paid. Number 7, no expiration date. Again, permanent life insurance is forever, especially if we structure it correctly. You have the ability to stop funding it if you want to pretty early on in the policy in a matter of 3-4 years. So there's not going to be an expiration date on the policy. The expiration date is when the individual dies. The death benefit pays out to the beneficiary or the trust, whoever owns the policy. 8, stable investment component. Again, that's why most people use these policies for their opportunity fund, is because they've got, again, a guaranteed portion plus a dividend, but they can pretty much count on a 5-6% return every single year of the policy. Doesn't matter what the market does, right? And this was the case during the Great Depression. Insurance companies continued to pay out a consistent dividend. This was the case in high interest rate environments back in the 80s when interest rates spiked. And it was the case in 08. It's been the case today, right? They're still consistently paying out 5, 6, 7% dividends to these life insurance policies. Number 9, policy loan options. This is probably the biggest reason why our clients use these policies, because of the loan provision. You have the ability to access the cash value. You could access it just as a withdrawal, just like you would a bank account. But if you access it via the loan provision, the insurance company continues to credit that interest as if the dollars never left. And you can use those elsewhere to, invest in a piece of real estate, invest in multifamily syndication, ATM fund, car wash fund, right? Anything that produces cash flows is what our typical investor is putting their loans into. And then lastly, potential for improved financial security retirement. It doesn't matter what the market does, your insurance policies are going to earn 5-6% every year. In addition to that, it's a tax-free income, and you can take out tax-free income in your retirement, and then it's going to pay a tax-free death benefit. Probably one of the things that people most underestimate is that it's a non-correlated asset to the market. And what I'm saying is, let's say you've got $4 million sitting in a 401k and you're pulling out 10% a year, $400,000. That's much more than the recommended amount by most advisors. Even Wall Street would tell you to only take out, 2.8 or 3.2% is the safe withdrawal rate. So if you're taking out 10%, you're being very aggressive. Well, if you have a life insurance policy that has, let's say, $1.6 million cash value that you could use, right? That's 4 years of 400K. Any year the market, we don't have a crystal ball, but any year the market has a downturn, right? We don't have a crystal ball, so we can't do it that year, but the year after there's a downturn, instead of withdrawing the 400K from our 401K or our market-based assets, we're gonna let the market-based assets rest. And we're going to take 300, 400,000 from our life insurance policy as our income that year. And what that does is it extends the life of your market-based assets by decades, because you're letting these assets recover from these down years because you have a non-correlated asset. You have an asset that is not correlated, that's liquid, that's available to you at any point. And so it does provide a large amount of financial stability. So those are the 10 reasons why ChatGPT thinks whole life insurance is a phenomenal financial tool. I added quite a few things that ChatGPT didn't because I asked for a simple explanation. If you have any questions, click the link in the bio. Make sure to like this video and subscribe for more content like this, and we'll see you on the next video.